risk is not an inherently bad thing. Risk just has to be mitigated, and it has to be prepared for, and you really have to pay attention to what you're doing.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Welcome back, everybody, to this special edition series of Meech's Wrestling Payments podcast, FinTech Shark Week, hosted by me, Elyssa Morgan. In this episode, really excited to delve into the complexities and opportunities surrounding FinTech partnerships for financial institutions, tying our discussion to Mark Forbis, one of our guests' recent article, Building Smarter FinTech Partnerships for Innovation and Risk Control. We'll explore the primary reason behind financial institutions' hesitation, the balance between innovation and compliance, and the structured evaluation frameworks that can help assess potential FinTech partnerships. So our conversation will highlight successful FinTech partnerships and the risk management strategies employed, key risk areas to address, and the importance of continuous monitoring and clear contingency plans. All right, really excited to introduce you all to our guests today. We have Stephen Coburn from Avalo Labs. We have Mark Forbis, former CTO of Jack Henry. And then we have our very own Mary Mumper Morrison here, who knows all the things about risk and compliance when it comes to the payment space. So really excited to have you all here. Stephen, do you want to introduce yourself, let folks know the type of work you and Avalo Labs are doing in this space?
Yeah, of course. I'm Stephen Coburn, CEO and co-founder of Avalo Labs. And what we have done is we've created a treasury management platform with a key focus on compliance and information exchange to really empower banks to safely and soundly go into any kind of business in which they're providing services not just to their customers, but also providing payment services to their clients' customers. So that being, FinTech banking, banking as a service, correspondent banking, money transmission banking, you name it. If it's considered a higher risk business, then our platform enables you, your compliance team, and your operations team to all be on one platform communicating with each other and exchange that information quickly and efficiently. And, at the end of the day, keep you out of any trouble with the regulators and your auditors, right? So that's who we are.
That's a plus. Mark, did you want to step in and kind of introduce yourself, let folks know what you're doing now after your stint at Jack Henry?
Sure, thank you. 32 years at Jack Henry, left after, retired in 2019 as CTO, and since then joined Stephen on the board of Avalo, helping them, and then also sit on a couple of bank boards, Incredible Bank in Wausau, Wisconsin, Citizens Bank in Batesville, Arkansas, sit on the board of Teslar. Some people may know them as loan exception tracking and portfolio management software system, known those folks for a long time. Also sit on the board of Digital Check Corp. Everybody knows them from the check scanning area, but also now some of their cash and cash management tools. Was on the board of Allied Payments until we recently just sold to Autobooks last week. And also am an executive partner with THL, helping with financial services due diligence, and do a few other things with Graph.io and Gorilla Logic nowadays. So just staying busy in the FinTech space. Enjoying it.
I was just going to say, keeping busy. That sounds like a lot. That's great. So if you guys just kind of want to jump into things here, for the folks listening, Mark did come out with this great article that Nietzsche is happy to share and link in the description here. So feel free to take a look at it. But we're going to kind of pull that apart a little bit and talk about the different areas. And I'd love to start where you mentioned innovation and compliance, Mark, aren't opposing forces, right? They can complement one another. Or I'll do that over. They can complement one another. So how would you guys say financial institutions can kind of balance innovation with compliance when partnering with FinTechs?
Yeah, I think that the key with any time you partner with a FinTech, and we all know that everybody's concerned about risk management, third-party risk, and all the touch points that go with that. And I think to think about it from a standpoint of, you have a strategic plan, you have a strategic direction, you want a FinTech to come in and help you. You have to get your compliance team involved, right? I mean, there's there's no easy button. And I think that's, to me, that's what I'm saying about, balancing those two, innovation and compliance. We know that we probably can't solve all the problems with our current offerings, and we want what the fintechs can do for us, right? They're more nimble, they're moving faster, they're digitally based, they're born in the cloud, all those things that we know our customers and our members are asking for. So how do we offer those type of solutions, but knowing that they may not be as fully understanding all the risks that go into running a bank or a credit union and dealing with those issues. So I think that's where I see the banks and credit unions that have been successful in this area, they really embrace their compliance team. And I think that's the way that I think you can balance those two. Stephen, I don't know if you have any comments on that.
No. I think that you've hit the nail on the head. Right? I mean, in the past, we've talked about partnering up with entities and companies or fintechs, right, that have compliance at the core and have that proper mindset. I personally believe that you need to have a good understanding of the fintech's culture and see if that fits the own culture of your own institution and your own values, right? And having a good understanding as to what they're trying to achieve, how they're going to achieve it, and from a compliance standpoint, what kind of culture do they have, and is it something that they truly live by? That will safeguard your own institution, and we want to make sure that those things match.
Right. I'd love to bring Mary in on this. I'd kind of put her in the hot seat a little bit because, Stephen, you had mentioned culture, and she repeats, session after session. She does a lot of education and the importance of just having this culture of compliance at your organization. She also, for you guys who are listening, and for you, Stephen and Mark, if you didn't know, she came to us from a fintech and was their compliance person. So I'd love to hear some of the kind of disconnect between kind of this fast pace, they're built for speed, and their requirement to meet certain obligations and compliance obligations. Mary, so have you kind of ran into where those two opposing forces you felt the friction, and how did you maybe move past that?
Yeah, so prior to coming to Niche, I worked for a fintech for a little bit over a decade, actually, after having worked for your typical, financial institutions. So it was a very different experience because the culture there in many of the fintechs is different. If you don't have folks who are familiar with what goes on at financial institutions, it's really hard. And it's not necessarily oh, we're just not going to do this. If you don't have that frame of reference, right, it's tough to kind of wrap your head around everything that a financial institution has to deal with when it comes to exams and audits and all the stuff that they have to do to, keep themselves healthy. So yeah, I definitely witnessed struggles between, well, we look at this and this is how we interpret it. And then the financial institution going, well, you don't get to interpret it the way you want to interpret it. They're going to tell you how to interpret it. So there is that bit of tug of war. And I think what Stephen said was really, really right on the money, is that you want to partner with a fintech if you're a financial institution where you have similar risk appetites, you have kind of a similar way of looking at things. And, because, every institution is different. Every institution has a different level of comfort with how they're going to comply with the rules and the regulations. And I think that culture thing is really incredibly important, that you find a good match so that you really limit those struggles if you are pretty copacetic in the way that you look at things. And hopefully, just, for third-party risk management, hopefully that is borne out in the due diligence that you're doing with your team before you go through all of the onboarding.
Well, that's, one of the importance, or there's a large importance, what I think is walking the halls, right, of where this fintech market is going to be. Because you can do a lot on the due diligence phase, right, and you can see, what's written down, but you really don't know that culture until you start really interviewing different parts of management. And don't just focus on management, right? You got to go and talk to people down the chain to see, well, are they actually practicing what these guys on top are selling? But once again, right, I mean, you got to find that proper alignment, especially when it comes to risk and risk acceptance, and, what that growth strategy is going to be. Over at Avalo, we think that, banks that know how to partner up with fintechs that have compliance at the get-go and as part of their core, I guess not just features, right, but that they're solving for some of these compliance challenges will allow them to be successful in their own growth and subsequently allow you as a financial institution hosting them and sponsoring these fintechs to be successful as well long term. And that's sometimes part of the problem of, some fintechs want to go out and grow as fast as possible, but you can't do that by cutting corners around compliance. And at the end of the day, it just becomes a very short mindset if you do, right? You could maybe grow for a year, 2 years, but you're going to lose your bank sponsor, or your bank sponsor itself might have to close down this whole line of business because of it. And we've seen many banks that over the past 4 or 5 years have gotten into providing services to fintechs and have started getting out, right, because of consent orders or cease and desist or you name it.
So it sounds a lot like finding the right partner that matches your risk appetite tolerance for that business line. You've pulled in all of the stakeholders from top to bottom and across the organization. And now, as far as risk management framework, having this intentional focus on this relationship and a structured evaluation framework. So Mark advocates for this in his article, a structured evaluation framework, continuous monitoring, clear contingency plan. Mark, what structured evaluation frameworks should a financial institution use to assess these potential fintech partners?
Yeah, and I think you hit on a lot of the topics, right? I mean, it does start with that due diligence, right? And there's a lot of, I think everybody has their own due diligence approach, and obviously we've got regulations that speculate how we should approach third-party risk management, which obviously needs to be as a part of that due diligence. It also starts, maybe even a little before that, and I think we're going to talk about it a little bit later too, is, why are you partnering with them? It has to align with your strategic goals first, right? So that's the first step of the framework, is not just because it's some shiny object and because it's cool or because you like it, but there is a lot of that out there, but it does need to align with your strategic objectives. Are we growing deposits? Are we looking for niche lending solutions? Are we trying to get into a new deposit growth area? Or are we going, into something much broader? Those all have their own separate sets of risk and risk appetite component. The risk assessment process, has to be a part of it. And I think I kind of outlined in the article, creating a scorecard. I'm big about scorecards, and obviously everybody that, that manages, and has KPIs or OKRs or whatever you want to call them from a strategic or project perspective, we should approach the same thing with risk. And then I think that, again, that alignment, with, okay, it does meet my strategic goal. It aligns with it. I've done my due diligence. Okay, now we get ready to start looking at how are we going to perform and operationalize these things? What are their contingency plans? Who are their partners? I mean, I think, there's a lot of connected components, but I think just coming up with the framework that meets your goals, but covers obviously all the check boxes, because we have to do that. I think that we know why we want to partner with fintechs, because they're built for speed, they're built for the modern banking era, and they hopefully will be solving the problems that we're trying to solve for our customers and members. So I think that just building your own framework is the key, whatever that is, and you can find a good one out.
And you say you can find a good one. It sounds like a lot of work, right? And I think that's because it's such a hesitation, they're seeing all of these examples with folks, some of them under consent orders and things like that, because they've kind of jumped into things. And I guess, is there you hear the bad news, and I think you guys had mentioned this on our recent webinar we all did together. You hear about the bad things, you don't always hear about what's going right. Do you guys have any successful fintech partnerships and risk management strategies that you've seen kind of explored and implemented that have worked for some folks?
Yeah, I mean, I just think, I think we probably tend to overshadow a little bit of, the fact that the majority of everybody that's out there choosing, something outside their core for digital bank, just plain digital banking or bill payment or fraud solutions. Those are three big areas that almost every bank and credit union already has something, and more than likely it's pretty successful. So, how did you go about doing that? Maybe we kind of gloss over that and we think more of the the niche solutions like, maybe a buy now, pay later solution like Affirm or Klarna, or we think about something like partnering with Dave, who has made some really cool changes in their business model recently, or things like Z Suite, right? I mean, so I think all those kind of, banks and credit unions that are partnering with those folks, and obviously Avalo to throw a current and recent example in there. I think those all work, and they solve a problem that the financial institution is really striving to solve. So I think we kind of tend to maybe focus on the high glossy, shiny objects, but there's so many just basic blocking and tackling items out there that are working every day. So that'd be my take.
Yeah, I'd like to add something that you mentioned earlier, which is, you got to start with the premise of what are you trying to achieve, right, as a financial institution, right? To kind of go back to this again, it's like, do you want to grow your deposits, right? And what type of deposits are you trying to grow? Are you trying to grow a loan portfolio focused on what, right? Are you trying to increase your non-interest fee income? Okay, well, you want to do that through, wire fees, or you're trying to do this through, other types of fees. Maybe it's loan origination fees, whatever it is. But as a financial institution, you should have a general idea as to, and maybe even specific, as to what kind of business you're trying to incentivize and do it well, right? If you're going to be a bank that wants to do a buy now, pay later, there are going to be some requirements that you're going to need from a system standpoint that, that you're going to be able to potentially offer to your FinTech partners. But once again, you want to make sure you have a good understanding as to what you're trying to achieve from a business standpoint, and make sure also that you've got the right tools for your team to be able to manage the risks involved with those businesses, right? I mean, if you're going to get in a highly intensive, payments business or FinTech payments business, then you want to make sure you got really good transaction monitoring, sanction screenings, tools to be able to monitor that effectively. If you're looking at doing card programs, then you might want to have really good fraud controls around that, right? So these are the things where a lot of banks that are trying to move quickly, sometimes they can get a little tripped up. And it's just a matter of making sure you've got a strong foundation to work from depending on what you want to do, right?
So something we're seeing more and more attention on is this need for financial institutions to have a clear line of sight into fourth-party risk. So it's not just about knowing your vendor, or in the case of FinTech partnerships, even your FinTechs customers and their relationships, right? These are the people you need that transparency through to. You need to be able to see who they're working with and who their customers are, right? So when we talk about partnerships today, it's important to recognize that the risk extends beyond that direct relationship. And with that in mind, what would you all say are the key risk areas that financial institutions really need to focus on when building out these kind of partnerships?
The FinTech that I worked for, so we offered an account. And at one point, we moved away from having our own in-house customer service team to outsourcing a call center to a third party that was offshore. And that fourth party, our bank partner, had a lot of say in that. They had a lot of monitoring that they were doing of the fourth party. They, all over any complaints, any consumer complaints about that fourth party. So they were well aware, but they had to be, right? Because they're partnering with us, but also what happens there is going to affect them because the accounts are held by them. So it is incredibly important when you're looking at these third parties to determine, are there fourth parties? And, take a look at the things like, do they have consumer complaints out there for those fourth parties? What is their, do they have a tanked BBB rating? What do they do? What happens if they go down? Is that going to directly affect us? Because it very well may. So that, I think, is all part of that third party due diligence initially, but also that continuing due diligence to find out, hey, have you added any? Is this still correct? Okay, so we still have that third party. Are they still insured, or are they keeping up? Have they done BCP testing so that if something goes wrong, can we be assured that business will continue and that we're not going to see a negative impact from it?
Yeah, and I think
those are my thoughts.
Yeah, to add on to that, I think the other aspect, and I think I kind of talked about it in my article about the 6 degrees of separation, meaning that we know about who our direct partners are, our third parties are, but and even the guidance right in the third party risk management has changed over the last couple of years to ask for those and look for those. Who are their service providers? Who are their high risk partners? And now we're as a financial institution being asked to make sure we understand those risks, whether it's just the fact that they're using maybe they're not in a public cloud, maybe they're on a hosted environment somewhere that we weren't aware of, or they use something like a fraud tool that we weren't aware of, right? Those are all the areas. So I think it does come back to what Mary said earlier about continuously monitoring. It's always that in-depth due diligence, those annual reviews, and now we're just asking those next set of questions. I think we've historically we've always we've gotten better at asking the questions to our third parties. Now we're asking a little more pointed questions about who our third party service providers are, right? Which is, to your example, Elyssa, is that those fourth party. So I think it never ends, right? We just we have to be very focused on and diligent about what's going on in our solution.
And when we think about operational resilience in the context of fintech partnerships, contingency planning becomes critical, right? Especially with the complexity of today's supply chains and this potential ripple effect that can come from a single point of failure. So whether it's having this backup for, say, a core process, which a lot of financial institutions already have in place, or ensuring that you're not overly reliant on one provider, building in that redundancy seems key in this long-term viability and stability in these relationships. And that's something, Mark, you actually highlight really well in your article, really this importance of both continuous monitoring and then having clear. So the importance of both continuous monitoring and having clear contingency plans in place. So with that in mind, how can financial institutions ensure that those elements, both the monitoring and the contingency, they're built into that fintech partnership right from the beginning?
I feel like we covered most of the topics that we wanted to hit. Maybe the one area, and maybe Mary just hit on it briefly, was, the contingency plan of, okay, we believe all of our partners are going to be around forever, but, what would happen, if we needed that? And then again, that's part of our third party management risk, and looking at scoring those and understanding, what their operational resilience are, what their BCP, DR plans are, but also, just having some type of thought process around what would happen if something happened to that service provider or that offering. I think just taking it a little step further, I think those are just more real examples of what have happened, unfortunately, in the industry. I still am a huge believer in fintech partnership. I think they're those partnerships are what are going to make FI stronger. Because look, and again, I was with a core for 30 plus years. We couldn't be all things to all people. And the more we tried, the worse it usually would get, because we would spread ourselves too thin. So I think that, we need fintechs, and I'm happy to say, the only thing I'm probably unhappy about right now is, that 1033 looks like it's kind of, it's been shelved. And I think that while I was a huge advocate in the past of, let's build the fintech community and let's build open banking and then let's build the regs, versus what happened in Europe, which is build the regs and then the open banking follows. And I think we've seen that it's had a different flow. I don't think open banking is necessarily as successful because of the regulations in Europe, but I don't know that we absolutely need regulations to be successful in the US, although I think it would help. I think it would help everybody understand their goals and their guidance. So that's the only thing I would throw in as a last topic. I think I'm hoping that 1033 will get resurrected some way, but I don't think it's going to inhibit open banking from continuing. Put it that way.
So I appreciate you bringing up the 1033 final rule, or the lack thereof this rule now, right? And I really agree with your stance on this, right? While regulation can provide clarity and help institutions better kind of understand their responsibilities, it doesn't really always make that process easier, right? So in some ways, I'm guessing I'm getting this right, you are saying really having that flexibility to kind of operate in a more open environment, not completely open, right? But what we're seeing currently in the open banking space might actually allow innovation to kind of take hold more naturally. And then once we start to see what works and what breaks, right, those guardrails or those regulations and rules and stuff can come into place, right? So it's an interesting tension between proactive regulation and adaptive growth. And I think your perspective on that is spot on. So thanks for sharing. Stephen, is there anything you'd like to add as we close out? Any final insights that you want to leave the listeners with?
Not, not really. I think we covered a lot here. I mean, going back to just that third-party due diligence, right, and the added party layers after that, right? I mean, from my background is from compliance and anti-money laundering, and I've worked as a consultant. I've helped remediate some banks their own compliance programs and help remediate some negative reports of examinations as well as C&Ds and consent orders and really when it comes to those risks, right? I mean boils down to that due diligence you're doing at a fintech and having a good understanding as to who their partners are, and also you need to start thinking of if you're a sponsor institution. Yeah, what happens if that fintech goes belly up, right? What happens to those clients? What if you've built this great, amazing deposit base based off this fintech opportunity, and now that fintech opportunity disappears, right? What are your contingency plans around that? I mean, last year we saw this big, huge collapse of Synapse, and that was a disaster, right? And it was a disaster. It was like a slow-moving train that a lot of people saw. There's a lot of red flags that were just very brightly out there, and it seems like they were unable to fix that. But I think that's also a lesson learned, right, as to, when you move quickly and you're partnering up with someone that's also trying to move quickly, like, are they doing the right things, right? I think from that, we've learned that, hey, we need more visibility as a bank as to who these underlying customers are, as to the accounting and the ledgering aspects of this, which are kind of the core facets of banking anyways. But I do think you need to keep thinking of, okay, well, what happens, right? And I've seen some banks already moving in that direction of, okay, well, they'll put a clause in there with their fintech partnership saying, hey, look, like if you get dissolved, then your client will become my client. And at the very least there, you can make a decision if you want to continue engaging in that business, or you even can, right? But you at least want to have that option. But once again, I mean, you need to view fintechs as a partner and help support them where you can. But you always got to be considering the risk, right? And that is a very real risk. Like every startup out there, startups, there's a high rate of failure. I think fintechs are probably a little bit better just because of so much scrutiny they have to keep up with. By the time they're able to build that bank sponsorship, you already have a lot of, at least a good backbone. But once again, like if you've got a very large prepaid card program, right, and all of a sudden that client is, it becomes a client of the bank, but what happens if that fintech disappears, right? You need to think about, okay, what tools will you have available to you to be able to manage that client? What kind of visibility do you have on those customers? We're at Avalo, we're huge believers in KYCC, knowing your client's customer and making that data available to you as a bank. Because at the end of the day, we want to make sure that you've got a very resilient program, especially for the worst case scenario.
And Mary, how about you? Any closing thoughts from your side before we wrap up?
I think maybe just building on what these gentlemen added, there's absolutely risk involved. Risk is not an inherently bad thing. Risk just has to be mitigated, and it has to be prepared for, and you really have to pay attention to what you're doing. So really, it's being thoughtful about what you're getting into and understanding what you're getting into, and then, doing the things that you need to do to understand the business that you're partnering with, to understand what they're doing, understand what their controls are, and just being proactive in implementing the controls that you need to implement. I think a lot of people look at it and be like, oh no, the risk, and there are things that you can do proactively to mitigate some of that risk. And will there be residual risk? Yes, of course. But you, in partnership with the fintech that you are doing business with, should be able to collaborate and deal with that in a way that is mutually acceptable.
Yeah, I'd like to add to what Mary's saying here, right, is that, as banks, I mean, that's the business we're in, right? I say we. I'm a former banker, right, so I'm always kind of got that mindset. But of, we're in risk management business, right? And it used to always be credit risk, right? But, over the last quarter century, we've seen operational risk management, right? It's become a big thing at multiple banks. And so you've got this framework already within your institutions. It's just about applying this to a customer of yours, right? And with FinTechs, operational risk management is a huge thing. You want to make sure you understand that risk that they present to you, and then depending on what kind of program they're going to be doing, there might be some AML risk management you have to do. There might be some credit risk management as well, whatever it is. But these are frameworks that as an institution you probably already have or have already gone through. You probably have some expertise within your own institution. It's just a matter of just applying those concepts to your clients as well. Your FinTech clients, that is.
Great point. There's risk everywhere.
So what a great conversation. Big thanks to Stephen, Mark, Mary for sharing your insights with us today. Today's discussion really highlighted that compliance and innovation don't always have to be at odds, right? With the right strategy and partnerships, financial institutions can really manage the risk and still push forward. It's not mutually exclusive, right? So we hope you'll join us for the next episode of our special FinTech Shark Week series, where we'll be busting some of the biggest myths around FinTech readiness and what it actually takes for financial institutions to engage in successful partnerships with emerging tech providers. So we'll see you next time. Take care, everybody.
On behalf of Niche, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of niche.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.